Hello and welcome to Wisdom Bites. Hope you're well. Thank you once again for joining us. Very much appreciated. And in today's video, I'm just going to do a quick follow-up from yesterday's video looking at the effects of the interest rate increase from the Fed and how it's going to affect the markets going forward in the next few weeks and months. I'll also be looking at certain key entry points for those of you with a different degree of risk attached to them. As we're coming towards the end of the bear market, not that we've already established a low, and obviously, as I've said many times before, my view is that 75% probability that the low at 17.5 is now in. However, there's still that 25% chance that we could go much lower, and I've given you those levels before. However, for those of you who are wanting to dollar cost average in at these levels, I'll give you some of the key levels of entry points that could be very useful, and these are the positions that I'm looking at. So I can only tell you what I'm doing, but please do your wider research before you make any decisions. So if that sounds interesting, then without further ado, drop everything, sit yourself down, eyes on the screen, and let's get cracking. As usual, please remember, nothing in this video should be taken as financial advice. Everything is for educational purposes. Please do your due diligence before you make any investment decisions. All I'm doing is providing you with a view. Obviously, there are many views, and you need to take all of them into consideration before you make any important decisions. Okay, so I'm going to start off with the 1 hour chart. As I said yesterday in my video, that please expect a lot of volatility around 7 o'clock, as that was the time of the meeting of the Fed to decide the interest rate hike. And we didn't know whether it was going to be a 1% increase, 0.75% increase, or a 0.5% increase. But certainly at that time, we were going to expect quite a bit of volatility. And this is exactly what happened. This is the candle here at 5 o'clock. And then just after that, a lot of speculation starts taking place. And look what happened. From 5 o'clock, speculation started straight away, as you can see with this green candle. And if we move forward, this is exactly what happened. So a lot of volatility went all the way down to 18,600 from 19,900. So people started to speculate just before the decision came through. Initially, it was taken badly because the price was pushed down to these levels at 18.6. But then the demand pushed it all the way back up to the body of the candle here at 19.6, a $1,000 increase from the bottom lows here. And then there was a further fall around these levels to around about 18,900. So by 8 o'clock, 9 o'clock and 10 o'clock in the evening UK time, we got this hammer candle at the bottom of the trend here with a lot of buying up as designated by this long wick here, which tells us that a lot of buyers came in at this point. So this is usually a reversal pattern with a high degree of probability. And since then, overnight and this morning, this is what's happened. So the hammer candle was a very good sign that we were about to go back up. So currently we're at 19,126. So this is just the effects of what happened from the interest rate hike yesterday. The main things to take from the meeting yesterday of the Fed increasing the interest rates was that they'd increased the rates by 0.75%, taking them to a range of between 3 and 3.25%. Their end of year target is 4.4%. So there is another 1.25 to 1.5% more to go between October, November and December. So we're talking about an average of around about a 0.5% increase in the next 3 months on average. So they could do a 0.75% next month and then taper that off in November and December. So whichever way they decide, at least we know that they're going to be going up more than likely by the end of the year to around about the 4.4%. And the inflation target is around about 2% from the current 8.3%. So we know where we are now, that hopefully by the end of this year, all the rate increases will be out of the way, so that at the beginning of 2023, we can look forward to a period of no interest rate increases. And if the economy shows good signs of inflation coming down, that it may well be that we may even get falls in the interest rates. So we just have to wait and see for what happens in the economy in the next 6 months or so. Okay, finally, I'm just going to have a look at some of the key entry points that are making themselves available in the current price action. A lot of people keep asking me, when is the best time to get in? So they're obviously holding a lot of cash and they're waiting for the appropriate moment. As you know, nobody really knows the top or the bottom. And as you know, my position is 75% probability that we've actually bottomed out at 17,500 back on 18th of June here. However, there is a 25% probability that we could fall down because we don't know next month if the inflation figures come out very, very high and the Fed, instead of expected 0.5% to 0.75%, they might put it up by 1% and that would tank the market. So we don't know what's going to happen. So we have to always give ourselves that wriggle room that there is a possibility and a certain amount of probability that we could go down to these levels here at 11.5, 12,000. But as it stands now, these are the levels that I'm looking at. The first obvious level is the previous all-time high of 19,800, call it 20,000. We know that at this level here, as you can see quite clearly, the price action has been interacting with this level for the last few months now. So this level shows that if we can close above that at the end of this bear market, whether it's now or in a few months' time, then that would present a very good opportunity to get in at the bottom or close to the bottom here. But a little bit higher than that, there are other levels as well. So let's have a quick look at these levels, which are presenting quite defined support and resistance levels. So just above that, there are certain levels that would provide a less risk, because obviously there's going to be more risk getting in here, as there is a chance that we could fall down from here. But as we keep going higher and higher, the risk to the downside becomes less and less. So if we have a look at this section here, the other levels to look at would be this 22,500, where once we got rejected from there, the market fell down. So once we get above this point here, it could well be that we could use that as a springboard. So these are nice, clean, defined levels here. Because as you can see, there's a lot of support and resistance here, a lot of interaction here, a lot of support here. And as we saw, we got rejected at this point here. So this is very good, clear, defined levels above which we should have at least a relief rally or a bounce to the beginning of the bull market. And the final level is, of course, this 25,000. Because if you look left here, this was a strong point where it got bought up. So this level here is around about the $25,500 mark. And as you can see, this is the big point that we got rejected around the August time. So these are the three clear levels to really be keeping your eye on. This $20,000 mark, 22.5, and 25.5 here. Okay, I'll leave it there. This was just a quick update from yesterday's interest rate meeting. I hope you found value in that. If you did, then please do remember to like and subscribe and to turn on the notification bell. And if you have any comments, questions or suggestions, leave them in the comments below. Until the next time, take care, stay safe, and I'll see you in the next video. Bye for now.